Beta is equal to n summation of x, y minus summation of x. Are you writing down? Yeah, summation of y, the whole divided by n summation of x square minus summation of x the whole square. So this is the formula to identify beta. Okay. So first we have to identify beta, then we have to identify alpha. Okay. So once we have identified beta, we will have the beta value. With that we can find out alpha easily. Then we can find out the expected return. Okay, how much with the risk, including both beta and alpha, what would be the return from the stock, we will know. So have you taken down this formula? Beta is equal to n into, it is something like a coefficient problem, right? The sum is actually correlation coefficient formula. The same thing is what we use for beta also. So beta is equal to n into summation of xy minus summation of x into summation of y, and n into the whole divided by n into summation of x square minus summation of x the whole square. So first we have to identify x, then we have to identify y, then we have to add all these, then we get summation of x and summation of y, then multiply some, then square root of x square, then we have to have this multiplication of this, then we have to separately square root x. Okay, so this is how we are going to find out. And another formula is, we need to find out alpha. So alpha is equal to, we need to find out y bar. Okay, y bar minus beta x bar. Okay, so this is what we have to find out. So we need to find out y bar minus x bar, beta x bar. So this is the formula. Shall we move on to the sum? Have you noted down the formula for beta and alpha?
Yes, ma'am.
Okay, so now we move on to the sum. So here, how do we find out x? X return is, this is actually, there are 10 values. See, 10 days values are given. 2, 3, 4, 5, 6, 7, 8, 9, 10. So there are, actually we have 10 days value, but we need to calculate, the x return is calculated based on today's price and yesterday's price. So if I calculate x, if I need to calculate for 5, I need to calculate 4 date 4, right? I need to have the previous day data. So I don't have here previous day data for 5th. So I have the previous day data only for the 6th. So the number of x that I will have here will reduce. It will not be like 10 days as given here. It will be for 9 days. So x return, the x, how we calculate the x? X is today's price minus yesterday's price, the whole divided by yesterday's price into 100. Okay, so this is how we calculate. So I'll just try in Excel. You can, if you want, you can also try uh, with your uh, with your laptop, or handy, you can do it. So how am I going to do for this? Okay, so I have I just put it x, so I put this in the bracket. So today's price, so which is C4 minus and C3. Okay, C4 minus C3. Okay, I need to again divide it. So again I have to give this one I need to give. Okay, this is one command and this is another command. Again I have to divide that by x yesterday's price, so that will be C3. So now I will close the entire thing black. Okay, so this command, so the whole thing I need to multiply into 100. Okay, so the answer is minus 6.54. So what I do, I just need the data, just two. If I have two things, it's fine. So you are able to find out how am I doing. So similarly for the next day also I can do it. So this is for 6th I found out. So I have to find out for 7th. So 7th similarly I have to calculate. So I will do it again. C5 minus C4 again divided by C C4. Guys, you are able to follow? Into 100, right? So
Yes,
this
ma'am.
also, yeah, because since I'm using Excel, it is easy, right? So now what I do, I'm going to drag this. So I got the value for everything, right? Now if you see, I got for 9 days only. I can calculate for 9 days because I the previous, this fifth day, fifth doesn't have the fourth day the data, so I can't take that. So only 9 I take it. So if you calculate x is minus 6.54, 3.37, you can take down the values, note down in your note. Maybe you can, with your calci, you can try this. See, this is the formula. Have you taken down this x written formula and y written formula?
No, ma'am, just a minute, noting
Yeah,
it
yeah,
down.
please take down. If you do not use this formula, you will not get minus 6.54. Have you taken down? So take the values also. Minus 6.54, 3.37, minus 3.01, 0.14, minus 1.57, minus 2.28, 3.28, minus 0.95, 0.47. So this is x value we have identified. Similarly, I am going to find out y value also. So y value also we are going to find out the same way. So is equal to first command. I give the first command, which is D, right? So D4 minus D3, close the bracket, divided by D3. Again the command is over, into 100. Okay, so again I don't want this for too many decimals, so I just end with minus 4.52. So again the next one I do like that. So again this will be D5 minus D4 divided by D4, close the bracket, 100, enter. Okay, so now what I do, I just drag it. So this saves my time. You can note down the values. Okay, so minus 4.52, 2.13, minus 3.96, minus 0.94, minus 1.71, minus 4.76, 8.00, minus 0.04, and 6.50. Have you noted down?
Please hold on for a minute. I'm noting it down.
Yeah, yeah, yeah. Please, please note down. No hurry. We can slowly go.
மேம்
Yes, ma.
மேம் இப்போ நெகட்டிவ்ல வருதுன்னா என்ன மேம் மீன் பண்றாங்க அது?
Negative வந்து வருதுன்னா அப்போ in today's price minus yesterday's price, right? So yesterday's price was higher and today's price was lower. Negative is that because today's price minus yesterday's price. So it means that today's price is lower. You see that here 570. So today's price is 570. Yesterday's price was 597. That is why it is negative. Got it? So today compared to yesterday's return, today's return is negative. That is what they mean. Okay. Now.
ஸோ அது ரிட்டர்னை
Yes.
வந்து அஃபெக்ட் பண்ணது தான் மீன் பண்ணது.
Yes, ma. Yes. Because we are calculating the beta. Right, this is, see, this is the market index. What you are having here is market index, and this is one particular stock. This is index return, and this is called stock return. Right, we are comparing beta. We are going to calculate beta, and we check whether this particular script is in line, whether it is in line with the market risk. We see what is beta. Beta is, we check the correlation of the script with that of the index. I told you, right, the beta should be always 1. If the beta value of the stock is 1, it means the script is in line with the market. If the market rises, the value of the script also rises. If the market falls down, the value of the value of, to the percentage of, see, if 10% market increases, the stock price also, stock of that particular company will go by 10%. That is beta 1. Rather, market is 1, right, but the script is 2. It means that if market moves by 10% up, the stock price will move by 20% up. That is very risky. Okay, so how do we calculate the beta? We have to take some 10 days or 12 days return, right, index return as well as stock return, and we see the correlation, because correlation we just cannot establish with one day, right, one day relationship. We have to take over the period of relationship. So when you check the over the period of relationship, what happens, you will know whether the stock, because we are checking with one particular company, right, the multiple companies also you can check, because here we are picking up only one company stock. So this beta we check up for that particular company, so we consider that particular stock and we match that with the index stock, index return. Okay, so that is why we are taking over the period of the time and we match them. This is I told you, right, this is formula for beta, which is actually a correlation formula, right, which is called correlation coefficient. We are using a correlation coefficient, and that will tell whether it is the negative value or a positive value. You must understand, see, with just one day or see, there are positive return on other days also. These are all positive return. So market is subject to risk, and the performances of that particular market also changes day on day. So some days it may be positive, some days it may be negative. So that we let us not bother. We need to bother only about beta. Okay. Have I answered your question?
Yes, ma'am.
As far as stock is concerned, we cannot just decide anything for that day performance. Okay. You have to analyze for a particular period. We have to, that is why in particularly stocks, when we pick up by the company performance, right, we have to consider, we have to see the performance of that company stock over the period of the time, and particularly when there is a recession or depression, or even when the economy is doing good. In all, that is called sensitive analysis. We do a sensitive analysis. What is sensitive analysis? Sensitive analysis does this kind of a return when the stock in normal economy, or when the stock in depression or recession economy, or when the stock is in very good economy, right? We have to consider, that is a sensitive analysis, right? So when you do a sensitive analysis for all these, only you can consider. See, you are going to invest, so you have to do lots of exercise, right, when you are considering about picking up the stocks. Okay, so now I have taken x is the market return, and I have taken y is the company return. Now I have to find out x square. So x square, how we find out? So we just have to 2 times multiply, right, that's it. So here it is B19 into B19. So 2 times we just multiply, we get one answer. This is 42.77. So I just want two data. So here I calculate, I get it for everything, right? So 11.36. So square root of 3.37 is 11.36. Square root of, so negative will become positive here when you multiply 3 times. So you don't need to bother whether you have negative here or positive here. It's only when you sum up everything you need to bother. Okay. So here, so have you written down x square value for all this? 6.54 square root is 42. See, square is 42.80, 11.36, 9.05, and 0.02, 1.57, which is 2.45. So 5.19, 10.77, 0.90, 0.22. You got this? And similarly, I do for here also. So which is I just multiply 2 times and D19. So D19 again multiplied by D19. Okay, so I get this answer. I just make it only 2 decimal. Okay, when I convert this into decimal, it becomes 40. Okay, so this is the value. Everything has become like this. Okay, now I need to, have you copied down, guys? Guys, are you with me?
Yes, ma'am. Yes, ma'am.
Yeah, please copy down. Any doubts, please ask me then and there. I'm only taking the components. I found xy, I found x, y. So I'm only finding the components. Okay. So I just put that into a sum and it makes my job easy. Okay. You have written down the formula. You are only going to tell me. I am not going to do anything. Okay. Now I am going to calculate x and y. So here the plus or minus job comes here. Okay. So here what is value of x? Value of x, which is B19, right, into D19. Okay. So these two things I multiply. Okay. So again I just want 2 decimals. Okay. So I just drag this. So this is my x value. So here it is negative and here it is negative. So negative and negative become positive. So all the signs, that is the beauty of Excel. Okay, now this is what the value I got. Now I need to find out the summations, right? So what I do, I need to put a symbol. I'll take a summation symbol. Okay, so I copy that to everything. Okay. So now I need to first write the summation of this. Summation of this, I need to just, what I do, I have to just put sum. So what is the sum? Sum is equal to D19. This will not include this because I have put a summation symbol, so it will not work. Okay, so here I get which is 7 minus 7 point. I have to just copy this. Okay. minus 7.08. I just write like this, minus. Guys are able to follow? I'm just adding up because I need summation, right? I'm just adding up.
Yes, ma'am.
Yeah, and here it is, and I just include all that, which is 82.76, which is positive. You can copy it, you can work out later also. 76, and here it is 0.78, which is positive, and here it is 173.39. Okay, and here 91.32. Okay, now I found out everything. Okay, you are going to tell me what is the formula that we have used. I'm going to now find out beta. Okay, I'm going to now find out beta value. Okay, so I don't know, the symbol beta is here. Okay, so we got beta here. So now, okay, now the very first one is n. So what is n? What do you mean by n? Just take this formula. I think you have
Number
written
of
down this.
items.
Yeah, you have written down this formula, right? I'm going to just I'm just going to take the values for each one. What is n? N is the number of rows. Yeah, number of items. So 1, 2, 3, 4, 5, 6, 7, 8, 9. So I just put 9 here? No, 9 I have put. What is the next one? N is multiplied with what?
Summation xy.
Summation xy. What is the value of summation xy?
91.32.
91.32. Okay, the two values I have taken down. So what symbol next comes? Minus. Okay, minus. Yeah, first one is what?
Summation x into summation y.
Yeah, summation x into summation y. Summation x is, this is summation x. Okay,
Minus
so I am just going
7.0.
to put minus 7.08. Again, it is multiplied. Okay, so I just have to close,
Into
multiplied, minus summation of
0.78.
x into summation of y. So multiply 0.78. Okay, this I have completed. Okay, the whole divided by. So what is the first item? Again I have to put n
Into summation
into
x square.
summation of x square. So this
X
is summation of x square, which is
82.76.
82.76, right? And
Yes.
minus summation of x the whole square. So summation of x the whole square. Okay, so minus 7
7.08.
7.08. I just put 2 here because I don't know the value. I can't write on the, I have to, otherwise I have to just put subscribe. I have to go to paragraph and change. Okay, you mean if I put 2 means it is square value. Okay,
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 ma'am.
so can you simplify and tell me? I'll also try I also try the value with Excel. You guys also please try that. Just put the whole 9 to 91.32 is F28. F28 minus, I have to put B28, 28, another command is in D28,
1909.
1.19,
1909.
yeah, 1.19, you got it right, very good. So I
Yeah.
just I'll just do this 9 into F C C28, okay, C28, okay, minus yeah, I think it will show me error, I'm sure. It's not showing me. I'm sure this will show me error. See, it's showing error. Okay, anyway, you have done the answer, right? What is the answer you got?
1.1909.
1.19. We'll just take it 1.19. So all of you got this value 1.19, which is beta. So the beta value is so the beta is 1.19. All of you have noted down? Guys, all of you have noted down beta value? You should have the calci with you. Okay, now we are going to find out y bar. Okay, y bar is easy. I'll just remove this. Okay, now I have to find out alpha. Alpha is equal to, I told you, y bar minus beta
X bar.
into x bar. Okay, so how do we find out y bar? Y bar is equal to summation of y divided by n. So what is summation of y? Summation of y is 0.78 divided by 9 is equal to how much? 0.78 divided by 9 is equal to
0.0866.
yeah 0.086.
866.
Okay, we'll just finish with this. Then similarly find out x bar. X bar is equal to summation of x divided by n. This is average only, x bar is. Okay, sorry, x bar. So summation of x is minus 7.08, right? Sorry, summation of x is 7 point minus 7.08, correct? 08 divided by n 9 is equal to how much? Minus
0.7.
0 point
0.7.
how much? 79.
786, ma'am.
Okay, a 78 can be made into 7986, right? You can when you put it, it will become 79. So I found out x bar and y bar. Please have the value and tell me here. I'm going to find out alpha. So alpha is, where is alpha symbol? The day we were searching for alpha symbol, right? Alpha symbol is not there.
Ma'am, in mathematical symbols.
Huh?
Mathematical symbols we were using.
Arithmetic. Where is arithmetic? I don't find arithmetic here.
I think it's mathematical, ma'am, and that they used.
Mathematical operator, there is no alpha at all. Okay, no problem. Alpha, you know, right? Alpha, how do we do with alpha? Alpha is one straight formula where it is y bar minus. So here we have done, right? Alpha is y bar minus beta into x bar. So I just put that here. So what is y bar? Y bar is
1.02.
0.086, no, 0.086 is y bar, right? Minus
Answer.
1.19, yeah, 1.19 into minus 0.79. So what is the value?
1.02.
1.02. 1.02 is alpha, right? So this is alpha. I'll just write like this. So this is alpha value, this is beta value. See, what is the question they initially asked? They asked us to find out the market return, right? So what is the formula for market return? I just take this new file. See, this is the expected return. This is very important formula, and we always use this formula. And this is the equation that we get from capital asset pricing model. Okay, so this is called R. Okay, so we are going to find out the value, right? I already told you RI is actually the return of the particular stock. So we, for return of the particular stock, we need to find out alpha, which we have already done. So alpha plus beta, into, we have to take the market return, right? And plus we need to take E1. E1 is the error. Normally in the sum they give. So once we found out alpha and once we found out beta, the market return they mention and the standard error they would give. So here I give you the standard error, market return standard error in the sum. If it is given, very easily you can find out. So once we, normally in the sum, I have just taught you how to find out alpha and beta. So this particular
And what is standard error, ma'am?
Standard error is normally when, see, we cannot 100% say that the stock is 100% free of risk. There are some errors we keep because the selection of any stocks always comes with some standard error. So standard error is statistical calculations we do it. See, these are all calculation only. So some errors we have to keep it. So normally that comes with that error. Okay, standard error. Standard error, I think I told you in the risk still. I think last week I told you. Normally, standard error we calculate when we are taking out the samples. So even you are picking up the stocks, not 100% that we would be selecting the stock which is not risk free, right? So we always keep some error. So whenever you pick up, you will not 100% pick up the stock of your desire. So that always comes with error. Okay, so now this is alpha and beta, where how we find out the expected return of a particular stock, keeping the market return and keeping the standard error, we calculate the return. So these two are very important because I'm teaching you the risk. That is why I taught you how we calculate the alpha and how we calculate the beta. Now the interpretation of beta. Okay, so if I say the beta, okay, now see what is the beta of this particular company stock. Beta is 1.19. Okay, now you can know the interpretations of what is the beta of this particular stock. Whenever we say the beta is positive 1, sorry, whenever we say the beta is, whenever the beta is 1, right, it means that 1% change in market return that causes exactly 1% change in the stock return. So it indicates the stock moves in line with the market. So it is very safe. So whenever the market increases with the return, the stock also will increase. Whenever the market reduces, the stock also will reduce. You must always see to it that you pick up a beta value, you pick up the stock where the beta value is 1. Because if the beta is more than, see, the market is 1 but the beta of your stock is more than 1, then very risky. Okay, then another one is if beta is say less than 1 but 0.5, 50 percentage of the beta, it means that any 1% change in the market, the return only changes only 50 percentage of the changes, that brings only 50 percentage of the change in the stock. So if the market is moves by 10 percentage, the stock will move up only by 10 percentage. Similarly, when the project, when the market is very risky, market is falling by 10 percentage, very safely the stock will fall only by 5 percentage. Okay, this is called beta of 0.5. Another one is beta of 2. When we say beta of 2, 1 percentage change, right, 1% change in market that causes 2% change in the stock return. So the stock return becomes more volatile, and if there is a decline of 10% in market return, the stock with a beta of 2, that will give negative return of 20 percentage. So the stock with more than 1 beta normally considered to be very risky, right? And you can also say the negative beta values, that indicates that the stock moves in the opposite direction, right? So if I say beta is negative 1, it means the stock when moves positively, the beta will go in the opposite direction. Whenever there is a positive, it is positive correlation, the beta also moves upward, the script also moves upward. But when we say negative, right, even the market goes up, the stock would go negative, right, it will fall down. So that is negative. So if the market return declines 10 percentage, that time the stock would go up, so that is called positive. So systematic risk and unsystematic risk you can tell with this, with the graph I'll teach you. Guys, you are able to follow this?
Yes, ma'am.
Yeah. Now I'll tell you what is how do we write, how do we draw a graph, right? So here we are talking about the systematic risk, right? Systematic risk where with when the systematic risk is, because beta is a systematic risk, beta you cannot control. Okay, so systematic risk is market risk, we cannot control. So I'm talking about the market risk. Okay, and this is the stock we can say, sorry, this is market return. Okay, and this is the stock return. If I say where the beta, right, where the beta is equal to 1, so here this is the line. Okay, so this is the line. So here this different we say, right, this is called alpha, right, this is called intercepting point, this is called alpha, and here this is the risk, here the beta is 1, right? So the beta is market goes high, goes by 1, so it goes in line with the market. Okay, so this is where the market return is in line, the stock return is in line with the market return, where the interception point is this. On the other hand, when we say the beta is, when the beta is more than 1, when the beta is more than 1, in the sense when the market when the market is like this, right? When the market return is gradual, okay, when the market return is gradual, the stock return, and particularly when we say the stock return will be very high, okay. And on the other hand, when the beta is when the beta is less than 1, okay, less than 1 in the sense the value will be, it will be almost in line, okay, almost only minor difference, almost in line. So this is along with the line, this is almost on the line where the low, where the risk is very less, and this is steep where the return is high and it is not in line with the market. So this one you need to understand. So I told you about the intercept point, right? Alpha, we were discussing about alpha. So alpha is the characteristic regression line, okay. So normally here what we say, this is a distance between the horizontal axis and the intercepting point. So here the stock return is independent. So when we are talking about alpha, so alpha we are telling, right? So stock return, this is the stage where stock return is independent of the market return. So this is the point, this is the alpha point, right? I'm telling this is the point where whatever may be the market risk, the stock will not get affected because of that. So only beyond the alpha point where the stock will start that will reacting in line with the market, okay, with the systematic risk. So where we can say the stock return is independent of the market return. So the positive value of alpha is very healthy sign, rather the negative sign is where it's not so good. One second guys. Hello. சொல்லுங்க மாமா. Okay guys, I'm back. Okay, now you understood this. So till this point, when the alpha is positive, till this point, uh, this is free of market risk, okay, market return. So the stock performs quite independently. You got this? Any doubt as far as alpha
No.
beta is concerned? Any doubt in the sum?
No.
Any doubt in the sum?
No. No.
Others, everyone, please. Everybody? No doubt, right?
No, ma'am, clear. Clear.
Clear. Okay, now we'll move on to the returns that which I was talking to you, right? We Because that day I was talking you about the return, so expected rate of return only I taught you. Then I told you one. Let me come back with beta and alpha, because unless you know the beta and alpha values, may not be some places where like I taught you, right? The return when the market when the RM and the standard errors given, when you do not know to calculate alpha and beta, that time we'll get stuck. So that's why I came back and I taught you that. Okay, now we'll move on to the stock valuation, because I'm still in stock valuation, guys. We have still not gone for bond valuation. Stock valuation, I will teach you what is important only. I'm not going to teach you everything. Okay, so last week I taught you a simple way of how you calculate the arithmetic return, right? Average return. So average, just simply I told you how we calculate the average return. So you just add up all and divided by the number of years and you get the average return. And there is one more sum I taught you, anticipated return. Anticipated return where with the return multiplied with the probability. If you remember, I just if you remember this sum, this is what the anticipated return I taught you. So every return comes with a probability of, so there is 10% probability that you would get return 10, and 20% probability that you would get 11 and 40% probability that you would get 12. So like that we been calculating, right? So probability and security, and so return ER. So here we told you we have to multiply, right? This and this we multiply and we get that, and we totally we add up weighted average. You remember this last week we did? So this is called the return, expected return. You remember this? Then I calculated the standard deviation and we did it differently, the based on risk and based on return. You remember guys this one? Anticipated
Yes, ma'am.
return.
Yes, ma'am.
Okay, so
Yes,
I'm
ma'am.
moving on to, yeah, I'm moving on to, there are certain models, right? Like a dividend discount models. Based on dividend discount models, then how we calculate the how do we calculate the valuation of the stock, right? Because why we say valuation of the stock, based on the valuation of stock only we know that this is a better stock to pick up or not. So first I taught you how do you calculate the capital gain, right? Capital gain and dividend yield. If you remember last week class, I taught you, if a particular company, how much is the capital gain and yield that we got from a particular stock, and then I taught you what is the average return we calculate, and if the probability is given, how do we calculate the weighted average return, and then I taught you for that particular stock how, what is the alpha and what is the beta. Okay, and that is based on the risk level. I taught you how to calculate it. Now coming back to the return, there are certain dividend models, right? So based on dividend models we calculate, there are certain formulas involved when we are doing the dividend discount models. So there are single period, this model has got a single period model and multi period model. So for a single period how we calculate, and for the double period how do we calculate, right? So first I teach you for a single period valuation model. Please write down along with me. Okay, single period valuation model. So single period valuation model, normally the investor holds the stock for a year, right? We assume that the investor is holding the stock for about a year, and the return we take at the end of the year. So we say that if it is to be expressed in the beginning of the holding period, then we have to calculate in terms of the present value. Okay, so how do we do this sum here? Okay, I'll just take down the formula. Okay, so here we need to know what is the present selling price, right? So I have been holding it for the entire year. So end of the year, the return we normally take it. So if I'm going to calculate what is the value of the shares, right? We need to, how do we going to find out? So the formula is P naught is equal to, since it is a dividend model, so what is the dividend given? D1 divided by 1 plus the return plus, so what is P1? That is the price at the end of the period. Okay, so 1 plus R. Okay, so here P naught is what is the current selling price, right? So if I'm calculating at the end, right, what is the, if I'm calculating now, so I'm just analyzing the stock now, so I know what is the current selling price, right? And this is the selling price at the end of the year. Okay, and D is the dividend declared during 1 year holding period, and this is the investors, what is the rate of return that I want. Okay, so if the rate of return, we need to take it. Okay, now I'll just give you one sum based on this. So formula, have you written down the formula, all of you? P naught is equal to D1 divided by 1 plus R plus P1 divided by 1 plus R. So this is the formula. Please take down the sum. Okay, if the investor wants to get, please do the sum along with me. If the investor wants to get 20% 20% return by holding Maruti Suzuki stock for a year. Okay, so he wants to hold the stock for a year and he is expecting 20% return. Okay, he can find out. Are you writing down along with me? He can
Yes, ma'am.
find out, yes, he can find out whether the purchase price is high or low. Like he wants to check whether the current price is high or low, because he wants 20% return if he is going to hold for the year, and he can find out whether the purchase price, current price, is whether high or low. Okay, so Maruti Suzuki's price on 9th March 2012 was rupees 1341.90. Okay, and assuming that the dividend will be the same next year and the stock price will be around, so they say that the stock price will be around 1650. Okay, so they say that the present value can be calculated. So currently the Maruti Suzuki's price on 9th March is 1341. Assuming the dividend will be the same next year, the stock price they are saying that will be around 1650. They have to check whether the present value can be calculated. Okay, you can check whether the price is high in the market or low in the market. So the price value can be calculated. Okay, so what I do, so dividend we need to know. So dividend, currently they are giving dividend at 7.50, right? 7.50 is per share they are giving dividend. Dividend declared is 7.50. Okay, now I need to check whether I can buy or not. Now I need to exactly check what is P naught. P naught I do not know, right? So P naught is equal to 7.5. The dividend is 7.5. Okay, and 7.5, and this is 1 plus R. If you just check, this is 1 plus R. So what is the return expected? What is the return expected?
20%.
20%. So 1 plus 0.20 is 1.2. Can I write like that?
Yes, ma'am.
Yeah. So plus what is the current price? What is the expected price? Expected price is 1650. P at the end, next year, assuming price 1.2, right? So what will be the value? So what is 7.5 divided by 1.2? 7.5 divided 1.2?
0.25. 6.25.
6.25. Okay, 6.25 plus 1650 divided by 1.2.
375.
3
1375.
1375. So what is the total? 1381.25. Yes, so this is the total. Now what is the current, actually what is the purchase price now? The purchase price is this, right? The purchase price is 1341. What is actually the price should be in the market? Actual value in the market should be 1381. So the purchase price is actually selling at a lesser price than actual price. Okay. So whether the person can buy the share or sell the share.
He can buy the share.
He can buy the share because the price of the value of the stock is less now. So the lesser than the calculated price. So he can buy the share. Okay. So that is how we calculate single period valuation model. Then how we do at the multi-period valuation model. So multi-period valuation model. So again, how we calculate the multi-period valuation model? I write the formula because it is uh, for we need to do it. It continues like multi-period means for many number of years. So normally it goes like this: d1 divided by 1 plus r plus d2 divided by 1 plus r to the whole square, like that. It goes on till what is the end of the period that we need to calculate. It has to go. So in a very simple way, we calculate multi-period model. The sum is very big. So normally this sum, if you want, I can do it, but that goes 3-4 steps we need to calculate, right? So it is better you know how we do it than we for theory purpose. But I would advise you guys not to go for this, because for a part time I'm sure they will not ask so much sum. Even Anna University, they have never asked this much of sums, so I'm sure they would not ask. But anyway, multi period, knowing the formula is not a big deal. If you want, it just takes another 2 hours, so I'll just mention and go. So how we calculate for the multi period? So we just take the number of years that we do it. N summation n is equal to 1. Okay. So first we calculate the E naught. So E naught is the most latest earning per share. Okay. So that is the latest most earning per share. Then we divide that by D. So D is actually the dividend payout. So D divided by E, right? Dividend payout ratio, right, into 1 plus what is the growth rate. Okay. So what is it? Just know for your knowledge. No need to break your head with this. Then the whole divided by 1 plus R n. Okay. This is one part of it. And then you need to add with that another part. Another part is we need to take the PE ratio. PE ratio again E naught one G n plus 1 the whole divided by 1 plus R into n. Okay, so just know for the sake. So this is the formula. I will maybe type and give you, or I will just post in the group.
Ma'am, what is written in the bottom? In
Yeah,
the
yeah.
second part?
I'm posting in the group. Maybe I'll just post in the group. I have posted in the group. This is only for your knowing purpose. So this actually goes by 3-4 steps. So this may not be all the time asked. That's for your knowledge sake. Okay. So I'll teach you the constant model. Constant model is very easy. Okay. I have posted in the group. You can copy it from there. So multi-period model I taught you. I just mentioned you. Another one is constant model. Okay. So constant model. What is the formula for constant model? P naught P naught is equal to P naught is equal to D1, okay, divided by R minus G. Okay. So P naught is the present value, R is the required rate, and G is the growth rate, and D1 is the dividend. Okay. So we'll do one sum. These are all easy sum which you can do. So just take the example sum. So the company ABC here dividend per share expected to be rupees 3.50. The dividend in subsequent years the dividend in subsequent years is expected to grow at a rate of 10% per year. Okay. The required rate of return is 15% per year. What should be its price? The prevailing market price is rupees 75. Okay, guys, just read one more time. Here if you see the company ABC's next year dividend dividend per share is expected to be 3.50. So next year dividend is 3.50. The dividend in subsequent years is expected to grow at 10%. So if the required rate of return is 15% per year, what should be the price? So now the prevailing market price is 75 rupees. So we need to check. Okay. So I told you the formula here is P naught is equal to, so the dividend what is decided for the next year divided by, so R minus the growth. Okay. So here if you just check the dividend here, what is the dividend here? Dividend is equal to 3.50. This is what they have proposed for the next year. So 3.50, and what is the required rate? Required rate here is, because the company is expected to grow at 10%, the required rate of return is 15%, and the growth rate is 10%. Now just we have to directly put that into formula. So 3.50 divided by 0.15 minus 0.10. So is equal to, tell me the answer.
70.
70. So what is the current market price?
75 rupees.
75 rupees. So the price of the share, actually the investor will be willing to buy 70 rupees per share, because theoretical the market price is 75. So the current price is 70. So what the market, he will not buy now, he will buy the proposed period. Okay, he will not buy now, he will buy in the proposed period. So because current market price is 75, so he will wait. Okay, so that is the actual price is 70. Actually it should be 70, but current is 75. So if it is 70, he will buy. When it is 75, he will not buy. Okay, so this is constant value. Another one is another one method also we do it. So that sum also please take it. Okay, so take down. That Anil estimates that from investment on A, he would get 15% dividend in the coming year. It would continue to grow by 10% for the rest of the years. There are two formulas when we do in constant method. So one directly going with the required rate, and then the required rate and the growth rate, right? And another one we go by the rate, where this way also we can do it. So here he estimates the investment on stock A, you would get 15% dividend in the coming year, and it would continue to grow 10 percentage, right? The growth rate is 10 percentage for the rest of the years, right? So that the selling price is currently rupees 40. So the selling price is rupees 40, and he needs a return. So this guy requires, he needs a return. See, first formula we taught you what will be the prevailing price. So for the prevailing price, we have taken D1 divided by R minus G. Here we are going to calculate with the selling price and with the return, what is the return, actual return, right? So he needs a return of 20 percentage. So from this investments, we need a return of 20 percentage per year for his son's educational expenses. Okay, now you have to check, can he invest on stock A? Okay, so this is the question. So now he is expecting 20% stock, 20% return on this particular stock. Now we need to calculate whether he will get the stock return or not. Okay, now what is the formula? I need a return. So R is equal to the dividend divided by the prevailing price plus growth. This is the formula. So what is the dividend? Dividend is equal to, the dividend, expected dividend is how much? 15%, right? And what is the prevailing price? Prevailing price of the share is 40 rupees. And what is the growth? Growth is expected to grow at 10 percentage, right? Now put that, you will know expected return. So dividend is 0.15 divided by 40 is the price plus 0.10. So tell me the answer, please. 0.5 divided by 40 plus point. What is 0.15 divided by 40? 0.15 divided by 40 is equal to 0.00375 plus 0.10. So what is the value? Is equal to plus 0.10 is equal to 0.10375 into 100 is equal to 10.37. Okay, so what is the return, actual return that he will get from the stock if he picks up?
10.375.
So he wants 10, actually actual return from the stock he will get only 10.37. But how much is expected return? What is his expected return?
Percentage 20.
20. So when his expected return is 20, but the stock return is only 10.37, do you think he has to pick up the stock?
No, ma'am.
No, because it is not even 50% of the return that is expected return from the expected return. So he has to look out for alternative means. Understood? This is one method. So one method we found out with the price, with the prevailing price, with the price actual purchase price, because with the calculation considering the dividend, you are checking whether the current price is higher or high or low, right? Or you want to fix your return and you need to check that the current return is advisable or not. Okay, so based on the return and based on the price, purchase price, we are deciding. So this is constant model. Okay, so I think this two will do. And there is another one, we do it with valuation model. Another one, this is with this we can wind up. Okay, because I mean, as far as stock valuation is concerned, next week, when is your CT is scheduled? CT exam tentative date, is it it is around 19th, or when is it?
Yes, ma'am.
March 19th.
Okay, so next week we have still time, no? So I think
Next
yeah,
2 weeks maybe.
yeah, we have next week. So that time we will read about bond. So I want to finish two more things here. So one is Graham Dodd. Okay, Graham Dodd model. So this model also very important when it comes to a stock valuation model. So I'll tell you what is Graham Dodd model. So David Dodd is the first person. There are two researchers. One is David Dodd, another one is Benjamin Graham, right? So actually, this Benjamin Graham is the person who is the teacher of Warren Buffett. Okay, so they detail the basis for value investing in their security analysis, how we need to pick up the stock. So they have given the details on security analysis in 1934 itself. So this concept they developed when there was a great depression. I told you, right? Sensitive analysis, we need to do an analysis even when there is a boon, and even when there is a depression, and even it is a normal period. So this calculation they considered when there was a great depression. So according to these two people, Graham and Dodd, they say that there is something called intrinsic factors. So what are intrinsic factors? Intrinsic factors are related to the company. Okay, so like earnings, dividends, assets, and the capital structure. So what they feel, the stocks, they have a high earnings to price ratio if they have a low per equity, or a high dividend yield, and the price below its book. So they say that these are all certain intrinsic values based on which their you can pick up the stock. Even they identified there are certain stocks which were doing really good. even during the depression time when the entire stock market was crashing down, but still there were some company stocks were really held by the people. They did not sell off the stocks, and the market value also did not fall down, right? So they found out the major reason for this is these stocks were considered based on the intrinsic value. Okay, so he said that the intrinsic value, when you give importance to intrinsic values, then you can really rely on the stocks. So this is called P, right? PE. This is price equity, right? Price equity, based on the price equity he has given certain calculation. So there is some constant values is given, 8.5 plus 2 into growth. So this is the formula. See, these are all based on certain assumptions, right? So he says what is growth. So growth is the percentage rate of earnings, right? And if you want to include the price, see, sometimes it is something. If you want to know the price, it goes like this. If I say P divided by E, which is price per equity, is equal to, I say 8.5 plus 2 into growth, right? If I want to identify the price, then the earnings will go into 8.5, right? 8.5 plus 2g. So you can take the earnings into the other side, right? So that is called price. That is, we have to identify the price. So you have to just multiply the earnings into that. Okay, and
Means
or
2G into earnings also will be coming.
no, this is actually like this. Okay, so first we have to identify the relationship with this, then multiply with that earning. Okay, we'll do one sum in that. Please take down the sum. Man Shacks. So Goldman Sachs is one of the famous company. Once upon a time we had that. So it is one of the, somebody is joining very late. Okay. So they predicted, right? Predicted that TCS, okay, TCS sales will grow by 20%. Will grow by 20% up to 2013. They will grow up to 20% up to 2013. So assuming its earnings, assuming its earnings will grow. Because of this, they predicted the sales will grow by 20% up to 2013. Assuming this factor, the earnings, they decided the earnings will grow by 15% with the earnings per share of rupees 38.62 for the financial year 2010 and 11. Okay, so they're asking you to find out the estimated price. Find out the estimated price, closing price. They have given you the closing price of TCS on BSE was rupees 1192.55. Okay, so here we have to take this formula. Okay, so here I just want this price. Okay, so price is equal to, I put earnings. Okay, earnings into, I take this. Okay, now we just have to calculate the estimated price. P is equal to what is the earnings? Earnings is 38.62. Okay, then 8.5 plus 2 into what is the growth? 15. Okay, so that's all. So what is the answer? Estimated price will be, estimated price will be guys,
G is 0.15 only.
0.15. No, you can take it directly 15% because we are only calculating in percentage. Currently the growth is 15%, right? So when we are calculating this, we will calculate the total amount in percentage only. So no problem taking the total percentage also. Growth we are taking as such. So for this, you can take the growth. For this particular Graham Dodd model, you can go with percentage itself.
Okay.
Price is 1486.87.
1486.87. Now if you see what is actually the closing price in TCS, it is 1192. What is the estimated price? 1486. Okay, so how many percentage is higher? How many percentage is higher? Almost estimated price la 80% of இது இருக்கா? You just keep this 100%. 100%, 80% வந்து actual price இருக்கா? Okay, so it is almost 80% of what is the estimated price? Estimated price is 1486. So this price is 20% higher than the actual price. Yes or no?
Yes, ma'am.
Yeah, so
Almost
that is
20
the
to
case.
24.
Yeah, 20 to 25% higher. That is why I told you to take the growth by actual this rate. Okay, so if you just put point, no, because assumptions they ask us to take only this way. Okay, they don't want to convert that into 100. They wanted to take it because 2 into growth, so they are considering twice the growth and then they are checking it. So if that is the case, actually he has to buy. Okay, this is very much a buying proportion. So the investor, this actually this method, the estimated price making him to buy it. Okay, so this is how we calculate. Another one is Whitbeck-Kisar model. With this we'll wind up. Okay, so Whitbeck-Kisar model. So Whitbeck-Kisar also they have been using the same PE ratio only, right? Same PE ratio, but again they have certain constants like how they calculate. They have given certain fixed ratios where they have to consider the all standard deviation. They give you the dividend payout and the standard deviation risk also they include. So based on the risk they do it, right? So in that is the case, you can take down the formula here. So here if you take Whitbeck-Isker model, so PE, P divided by E is equal to, here there is a constant rate 8.2, right, plus the growth 1.5. You have to multiply 1.5 G. See, this is constant values. You can't ask why there is 8.2, why there is 1.5. These are constant values they have identified as per the assumptions they have made. Okay, plus 0.067 into the dividend payout. So whatever the dividend payout they have given minus the risk 0.2, whatever the standard deviation. This is sigma. Okay, sigma is this is actually standard deviation. This is the
Ma'am,
formula.
the formula is for?
The formula is for again identifying the estimate price earning ratio. Price earning ratio, what is actually the actual price earning ratio of the company with that with the estimated price. okay, with the given values. So they say that whether you can buy the stock or you don't need to buy the stock. See, these are all the calculations they have done when there was a depression. Okay, so there are certain assumptions they made and they have given some calculations. So these are all certain calculations they use in picking up the stock. Okay, so I'll give you there are some assumptions like if they have to check. See, there is if the PE, okay, the theoretical PE means what is given in the market. So theoretical PE, if the theoretical PE is greater than the actual, right? If the actual PE is greater than the theoretical PE is actual than PE, you need to sell. No point holding the stock. But when the PE, when actual PE, the theoretical PE, which is you are getting in the sum, is lesser than the actual PE, then you need to buy. So this is the strategy. I tell you with one sum. Okay, then you will understand. Please take down. Company A's. Okay, one more thing I want to ask. You guys, did you mean you were able to go through all the videos which I shared last week? Did you get the videos? Someone took, yeah, I shared to somebody.
Ma'am, you share to me. I will send to everyone today, ma'am.
You will send to everyone. No, you are able to open the videos and then go through all the videos.
Last time I tried, it take long time to download, so I didn't
So
check,
one, I
ma'am.
think one video you need to download because each video goes close to 2 hours, and that's why I did that with my drive. So try one by one, and then if it is not, then we have to find some other way. Otherwise, I need to upload in YouTube, and then I have to share the link.
Your lecture video, ma'am.
Yeah, my lecture video, last 4 weeks video.
Okay.
I've shared to Muthupriya. Muthupriya, did I share it to you?
Yes, ma'am.
Yeah, yeah. So it is with Muthupriya. She will. I have shared to her mail, and maybe I think you can forward to everyone just like that, and then we'll check whether they are able to download and listen to it. Okay. This I wanted to check. Okay, this one. So company A's stock growth rate is 15%. So they have given the growth rate. So the company stock rate is company A's stock growth rate is 15%, and its dividend payout ratio. So dividend payout means I hope you guys must have studied financial management, right? So in financial management, in dividend policy, what is the percentage of dividend they give? So that is called dividend payout ratio. So it's dividend. The dividend payout ratio is 40%. So they are giving 40% as dividend payout. So very big company, 40% dividend payout person, and its standard deviation. And its standard deviation, the growth rate is 5%. Okay, the value of this is called a theoretical value when it is given in the sum, right? The value of the PE ratio, if it is given in the sum, it is called theoretical PE. So theoretical PE ratio is 22. Sorry, this is actual, right? Actual PE ratio when it is given in the sum, the actual PE ratio, right? So actual PE ratio is 22.5%. Okay, and on the basis of Whitbeck Kishore model, what is your advice? So we will give the advice. So this is the formula. Okay, so this is the formula. Okay, so I just go this way. So I'll just adopt the values. You have written down the value. You just need to tell me. Okay, so the very first one, the standard rate we said 8.2. Yes, 8.2. plus 1.5 into 1.5 into what?
Growth.
Growth.
G.
So growth is 15. Yeah, 15. 15% is the stock growth, right? So 15 and plus and again constant value which is 0.067, right? Into dividend payout. What is the dividend payout? Dividend payout is 40. I'm taking all in percentage, just like that. I'm not converting them any, right? And minus 0.2 into what is the percentage? So standard deviation. Standard deviation is 5. My dear, quickly tell me what is the answer. So first we'll go one by one. 8.2 plus what is 1.5 into 15? So 15 la padi 7.5. So 15 plus 7.5 is 22.5. That is 15. Again 0.067. So 0.067 into 40. So 0.067, where is my calci?
2.68.
2.68. Okay. So 2.68 minus 0.2 into 5. 0.2 into 5 is 1.
1.
Okay. Now add all that.
32.38.
32.38. See, this is actually a theoretical PE, right? So when the theoretical PE is higher than actual PE, what we have to do? This is theoretical PE. I told you theoretical PE when it is greater than actual. What is the strategy? You have to sell, right? So now theoretical PE is 32.38, which is greater than the actual 22.5. So what he has to do? The stock can be sold, right? So sell. The stock should be sold short. The stock should be sold short. Okay, so you got it? Understand? This is called Wittbeck-Kisser model. Okay, see, I don't want to miss anything, whether you are getting or not, but you need to understand. It is okay, we can take 10 minutes additional, but we need to know the maximum when it comes to a stock valuation. I think I have given all the details about capital gain, dividend yield, average, arithmetic mean, and I told you the weighted average method also I taught you, and today I taught you about the dividend models and single period valuation. Multi-period I told you not required, and then I taught you about uh, what is another one we learned, this constant, right? Constant values, dividend models, then constant value. Then I told you about the Graham Dodd and the Whitbecker. The last one is the preferred stock, right? Preferred stock valuation.
Beautiful girl.
So preferred stock valuation. So here preferred stock valuation is normally provided when there is a fixed income return, right? So here how do we calculate P naught? P naught is equal to, very simple, dividend divided by R. That's all. So we take the dividend paid and what is the required rate, we calculate, right? So very simple, we can calculate. There is one sum I can give you. With this we'll wind up. Okay. Suppose preferred stock annual dividend is rupees 4 and the required